India has always been a major player on the global economic stage. Recently, it has taken center stage once again. The country has been actively intervening in the foreign exchange market. This is a significant development. It reflects India's determination to safeguard its own economic interests. The move has sent ripples across global markets. India's currency, the rupee, has been facing downward pressure. This is largely due to the strength of the US dollar. A strong dollar makes imports more expensive for India. The Reserve Bank of India, India's central bank, has stepped in to stabilize the rupee. They have done this by selling US dollar reserves. This intervention is a bold move by India. It shows the country's commitment to managing its currency. It also underscores the challenges posed by a volatile global economic landscape. The world is watching closely to see how this intervention plays out. The Reserve Bank of India has been the key player in this intervention. They are entrusted with maintaining the stability of the rupee. The RBI has been actively selling US dollars from its foreign exchange reserves. This is a common tactic used by central banks to increase the value of their own currency. The RBI's intervention has had a notable impact. The rupee has stabilized somewhat against the US dollar. This has provided some relief from the intense pressure the currency was facing. However, the situation remains fluid. The RBI's actions are not just about the immediate value of the rupee. They are also about sending a message to the markets. The message is clear. India is committed to managing its currency and will act decisively when necessary. This intervention is a reminder of the RBI's crucial role in ensuring India's financial stability. The RBI's intervention has been welcomed by some and criticized by others. Supporters argue that it was necessary to prevent a further slide in the rupee's value. Critics argue that it could deplete India's foreign exchange reserves. Only time will tell what the long-term impact of this intervention will be. This is not the first time India has intervened in the Forex market. India has a history of taking action to safeguard its currency. In the past, India has faced similar challenges with a weakening rupee. This is often linked to global economic uncertainties or domestic factors. One notable example is the 1991 balance of payments crisis. India was on the verge of defaulting on its foreign debt. The government, under then Prime Minister P.V. Narasimha Rao, took drastic measures. These included airlifting gold reserves as collateral for loans. This crisis led to major economic reforms that opened up the Indian economy. In more recent times, the RBI has intervened during periods of volatility in the global currency market. For instance, during the 2008 global financial crisis, the RBI actively managed the rupee. They aimed to prevent excessive depreciation and maintain stability. These past interventions highlight a consistent pattern. India is willing to act decisively to protect its economic interests. The current intervention is a continuation of this approach. It reflects India's understanding of the importance of a stable currency. India's Forex intervention highlights a broader issue. It's the dominance of the US dollar in the global financial system. The dollar's strength has a significant impact on emerging economies like India. When the dollar appreciates, it becomes more expensive for other countries to buy essential commodities. These commodities are often priced in US dollars. This can lead to inflation and economic instability. India, like many other emerging economies, relies heavily on imports. These include crude oil, which is priced in US dollars. A strong dollar increases India's import bill. This puts pressure on the rupee and can contribute to a trade deficit. The dominance of the dollar is a complex issue with no easy solutions. However, it is a challenge that India and other emerging economies must navigate. It's a factor in their economic decision-making. This includes interventions in the Forex market. Section 5 BRICS. A new dawn for local currencies? India is not alone in its efforts to reduce reliance on the US dollar. Other emerging economies are also looking for alternatives. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been particularly vocal in this regard. The BRICS nations have been advocating for a more multipolar global financial system. This includes promoting the use of local currencies in international trade. The aim is to reduce dependence on the US dollar and create a more balanced system. The BRICS New Development Bank, established in 2014, is a testament to this vision. The NDB aims to provide an alternative to the World Bank and the International Monetary Fund, which are seen as being dominated by Western countries. While the BRICS initiative is still in its early stages, it represents a potential shift in the global financial order. If successful, it could lead to a more equitable system that is less reliant on the US dollar. Section 6. Global trade implications, transparency and stability at stake. India's Forex intervention has implications that extend beyond its borders. They raise important questions about global trade, transparency, and market stability. One concern is that currency interventions can distort trade flows. When a country artificially weakens its currency, it can make its exports cheaper and imports more expensive. This can create an uneven playing field in international trade. Another concern is that frequent interventions can create uncertainty in the Forex market. This unpredictability can make it difficult for businesses to plan for the future and can discourage foreign investment. Transparency is also crucial. When central banks intervene in the market, it's important for them to communicate their actions clearly. This transparency helps to maintain confidence in the financial system and prevents unnecessary speculation. India's Forex intervention highlights the need for greater dialogue and cooperation among nations. Open communication and coordination can help to mitigate the negative consequences of currency interventions and promote a more stable global trading system. Section 7. The double-edged sword benefits and drawbacks of intervention. India's decision to intervene in the Forex market is a complex one with both potential benefits and drawbacks. It's a double-edged sword that requires careful consideration. On the one hand, interventions can be an effective tool for stabilizing a country's currency and preventing a freefall. They can provide a much-needed buffer during times of economic uncertainty and protect a country from external shocks. Interventions can also help to manage inflation. By preventing a sharp depreciation of its currency, a country can limit the impact of rising import prices on its domestic economy. This can be particularly important for countries like India that rely heavily on imported goods. However, as we have seen, interventions also come with risks. They can deplete a country's foreign exchange reserves, create distortions in trade flows, and undermine confidence in the market if not managed carefully. The key lies in finding the right balance. Interventions should be used judiciously and strategically, and they should be accompanied by sound economic policies that address the underlying causes of currency volatility. Section 8. Conclusion. Navigating the complexities of currency markets. India's recent Forex intervention is a reminder of the challenges and complexities of navigating today's globalized economy. It highlights the delicate balance that countries must strike between managing their own economic interests and contributing to a stable and predictable global financial system. As we move forward, it's clear that dialogue, cooperation, and transparency will be essential. Countries need to work together to address the structural issues that contribute to currency volatility, such as the dominance of the US dollar and the lack of diversity in the global financial architecture. The future of the global financial system depends on our ability to find solutions that work for all countries, not just a select few. India's actions serve as a call to action for policymakers and economists around the world to come together and create a more equitable and sustainable financial order.